Hey everyone, welcome back to Corporate Decoder. Tonight we are diving deep into the financial statements of Lloyds Banking Group. And let me tell you, some of these numbers are as complex as a British tea ceremony, but we will make them as clear as a London fog rolling in. Before we get too lost in the financial jargon. If you love dissecting these kinds of reports, make sure you are subscribed. Oh, and we have a fantastic community on Discord. The link is in the description below. Come hang out with us. Alright, buckle up folks, because we are about to unpack the Lloyds Banking Group's annual report for the year that ended on the 31st of December 2025. This is their Form 20F filing, basically their yearly checkup with the US Securities and Exchange Commission, or SEC for short. Now, what is really interesting here, right off the bat, is the sheer variety of things this bank has on its books. We are talking about ordinary shares, represented by American Depository Shares, or ADSs, which is a way for regular folks like us to invest in foreign companies. But it doesn't stop there. They also have a whole list of debt securities, which are basically fancy IOS they've issued, with names like 4.344% subordinated securities due in 2048. Talk about a mouthful, and they have a lot of them, all listed on the New York Stock Exchange, or NYSE. Let's look at how many shares this giant bank has floating around. As of the end of 2025, they had over 58.8 billion ordinary shares. That is a lot of shares. They also have preference shares, which are a bit different, but the ordinary shares are what really drive things. So, how is Lloyds doing in the eyes of the regulators? They are firmly in the large accelerated filer category. This means they are a big player, they've been around for a while, and they have to follow some pretty strict reporting rules. And importantly, they are keeping up with all the digital filings. They have posted all their interactive data files, which basically means they are staying on top of their digital reporting game. Now, before we dive into the juicy financial details, they always start with a little intro. They clarify that the company refers to Lloyds Banking Group plc itself, and Lloyds Banking Group, or the group, includes all its subsidiaries. Think of it like the parent company in all its branches. One crucial point they make is that their financial statements are prepared according to IFRS, which stands for International Financial Reporting Standards. This is important because it means they are using a globally recognized accounting system, making their numbers more comparable internationally. And here comes the inevitable forward-looking statements section. Banks and big companies always include these. It is basically a disclaimer saying, hey, we're talking about the future here, and things could change. So don't blame us if our predictions don't pan out. They list all sorts of potential risks and uncertainties. From economic downturns and geopolitical events like the war in Ukraine, to changes in customer behavior and regulations. It is a long list, but it essentially boils down to the future is uncertain. And that uncertainty is a risk. Another important section is about enforcing civil liabilities. This is basically them explaining that if you have a problem and need to sue them in the US, it might be tricky because most of their directors and assets are in the UK. And if you get a judgment in a US court, enforcing it in the UK might be difficult. So if you are an investor, this is something to keep in mind. They skip over a few items here, which is common. For instance, they don't need to detail offer statistics or expected timetables, because this isn't a stock offering in the immediate sense. Now, let's get to the heart of what keeps the execs up at night, the risk factors, and Lloyds has a lot of them. They break them down into economic and financial risks, regulatory and legal risks, and business and operational risks. Under economic and financial risks, they talk about macroeconomics, liquidity, credit ratings, market fluctuations, and borrower credit quality. For regulatory and legal, it is all about compliance, capital requirements, anti-money laundering, and those pesky regulations. And then there are business and operational risks like cybercrime, new technologies, and even ESG matters, which stands for environmental, social, and governance. They really cover their bases here, highlighting every possible thing that could go wrong. Let's touch on how this behemoth came to be. Lloyds Banking Group has roots going way back to the 18th century. It grew through mergers and acquisitions, most notably the big one in 2009 when Lloyds TSB Group plc acquired HBLC and then rebranded to Lloyds Banking Group plc. It is a story of banks merging and growing over centuries. So, what does Lloyds actually do? They are a leading provider of financial services in the UK. Think banking, savings, investments, insurance. They've got a massive branch network and they're also big on digital banking. As of December 2025, their total assets were a staggering 944 billion. That is a lot of money. They had about 60,000 employees and reported a profit before tax of 6.6 billion. Their capital ratios, which are a measure of financial strength, were looking pretty solid. They organized their business into three main divisions: retail, which is all about individual customers, commercial banking for businesses, and then insurance, pensions, and investments. This structure helps them manage and report on their performance. Now, for the numbers that really tell the story, let's look at their average balance sheet and how much interest they made and paid. In 2025, their total average interest earning assets were a massive 730 billion, and they earned over 34 billion in interest on those assets. On the flip side, their total average interest bearing liabilities were around 535 billion, with an interest expense of about 19 billion. This difference, their net interest income, is a crucial part of their profitability. When we look at the changes in their net interest income from 2024 to 2025, it is a mixed bag. Their total interest income actually decreased slightly, mainly due to a drop in interest earned on loans to banks and reverse repurchase agreements. But their interest expense also went down, particularly from customer deposits. This resulted in a slight increase in their net interest income. This next table is super important for any bank. It is their loan loss experience. This tells us how much money they've had to set aside for loans that might not get paid back. In 2025, their allowance for impairment losses was 3 billion, down from 3.1 billion in 2024. This ratio of allowance to total lending is a healthy 0.6%, which is quite good. It means they are not seeing a massive increase in bad loans. As a percentage of average lending, the net advances written off remained at a low 0.2% for both 2024 and 2025. This shows they are managing their loan book pretty effectively. Here is a look at their investment portfolio. They have a good chunk of investments maturing within 1 to 5 years. Their loans and advances to customers are spread out in terms of maturity, with a big chunk maturing after 15 years, which is typical for mortgages. Customer deposits are the lifeblood of any bank. Lloyds has a massive 496 billion in customer deposits as of December 2025. They have a good mix of non-interest bearing demand deposits, which are essentially free money for the bank, and interest bearing deposits. And here is a look at uninsured deposits. This is the money customers have deposited that isn't covered by deposit protection schemes. They have a significant amount in here, over 203 billion, with a good portion maturing within 3 months or less. Good news for shareholders, Lloyds announced a share buyback of up to 1.75 billion, expected to be completed by December 2026. Also, they are recommending a final ordinary dividend of 2.43 pence per share, bringing the total for 2025 to 3.65 pence, a 15% increase from the previous year. This signals confidence from the management. Now let's talk about regulation. Lloyds is heavily regulated, primarily by the Financial Conduct Authority, or FCA, and the Prudential Regulation Authority, or PRA, both in the UK. These bodies ensure consumer protection, financial stability, and a competitive market. They also have to deal with a bunch of other bodies like the Bank of England and even the US Federal Reserve because of their operations there. Because Lloyds operates in the US, they are subject to US regulations too, including oversight from the Federal Reserve Board. They also have to comply with strict rules against money laundering and terrorist financing. Interestingly, they mention having limited business with countries like Iran, Syria, and Cuba, but state it is such a small part of their business that it is less than 0.01% of their total assets, so it is not a material risk. Here is a look at their organizational chart. The parent company is Lloyds Banking Group plc, and below it are its main subsidiaries, like Lloyds Bank plc, Scottish Widows Limited, and Bank of Scotland plc. Most of these are registered in England and Scotland and operate primarily in the UK. Okay, let's dig into the operating results. This is where the real financial story is told. Their net interest income, which is essentially the difference between the interest they earn on their assets and the interest they pay on their liabilities, was 13.2 billion in 2025. That is up 8% from 2024. Their net interest margin, a key indicator of profitability, also improved to 2.06%. This is driven by higher average interest earning assets, mainly loans to customers. Other income covers things like fees, trading profits, and insurance results. We see it includes net fee and commission income, net trading income, and insurance service results. It is a broad category that contributes significantly to their overall earnings. Operating expenses were 5.8 billion for the retail division, 2.85 billion for commercial banking, and 933 million for insurance, pensions, and investments. These are the costs of doing business, and the report details how they've increased due to strategic investments and inflation, but also highlights costs savings efforts. Impairment charges, which are losses on loans that are unlikely to be repaid, were $734 million for retail and $60 million for commercial banking. The report notes that 2024 had a credit due to an improved economic outlook, and 2025 has seen model refinements. Let's dive into the division that serves most of us, retail. Their underlying profit increased to $3.3 billion. This was driven by higher net interest income, thanks to more loans and better hedge earnings, and also by stronger other income from areas like motor finance. However, operating costs and remediation costs, particularly for motor finance commission issues, put a dent in those gains. Commercial banking also saw an increase in profit to $2.5 billion, higher net interest income from their deposit business, and a boost in other income from transaction banking helped here. Again, strategic investments and operating costs played a role. The insurance, pensions, and investments division made a profit of $330 million, a nice increase from the previous year. This was mainly due to higher income from general insurance and workplace pensions, plus the integration of Schroders Personal Wealth. And then there is the other category, which includes their equity investment businesses. This segment saw a profit increase, mainly from their residential landlord business, Lloyds Living, though income from LDC was lower. The report dedicates a significant portion to risk management. They detail their approach to credit risk, market risk, liquidity risk, and operational risk. They're very focused on managing these risks to protect the bank. Let's look at credit risk. They state that credit performance has remained strong and stable in 2025. The impairment charge was $795 million, up from $431 million in 2024, partly due to updates on their macroeconomic outlook. But excluding those macroeconomic updates, the charge is similar to 2024, which is a good sign. The total expected credit loss allowance is lower, reflecting strong performance and model refinements. Here we see how they categorize loans based on their credit risk. Stage 1 are the good loans. Stage 2 have seen a significant increase in risk, and Stage 3 are loans that are in default or considered impaired. The report shows that Stage 2 loans make up about 8.8% of their customer loans, and Stage 3 loans are about 1.3%. These figures are actually down from the previous year, indicating an improving credit quality. In retail, credit performance is described as strong. They highlight that in UK mortgages, new to arrears and default rates have improved. Unsecured portfolios in UK motor finance also show low, stable arrears. The impairment charge for retail was $734 million, higher than in 2024. But this is partly due to economic outlook adjustments. Their UK mortgages portfolio grew to $323.8 billion. They mentioned that new to arrears improved, and the portfolio quality is strong with good loan to value ratios. The impairment credit for mortgages was $60 million, lower than in 2024, again with favourable economic outlook updates. Credit card balances increased, and they described the portfolio as prime with low new to arrears and strong repayment rates. The impairment charge for credit cards rose because of updated economic forecasts, particularly unemployment. For unsecured loans and overdrafts, balances also increased. The impairment charge here is slightly lower than in 2024, with strong credit performance and model refinements playing a role. UK motor finance balances are up, but this segment is more susceptible to volatility in used vehicle values, affecting their impairment charges. In commercial banking, credit performance is also reported as strong. With robust credit strategies and underwriting standards, they are actively managing higher risk sectors and providing early support to customers in difficulty. The net impairment charge was $60 million, a flip from a credit in 2024, again influenced by macroeconomic outlook changes. Business and commercial banking lending reduced slightly, mainly due to repayments on government-backed loans. A net impairment credit was recorded here, driven by improved recovery expectations. Corporate and institutional lending grew significantly, reflecting growth in institutional balances and corporate infrastructure. The impairment charge here increased due to some single name charges. Okay, let's talk about their retirement obligations. They have defined benefit schemes totaling $26.6 billion. Valuing these is complex, involving actuarial assumptions like mortality rates, discount rates, and inflation. Small changes in these assumptions can have a big impact. So this is an area requiring careful judgment. This is a big one, especially given recent news. Lloyds has set aside $1.95 billion for motor finance commission issues. This is a significant provision because the final redress scheme details were still being worked out, and there is uncertainty about response rates and delivery costs. This is a prime example of how regulatory and legal issues can create massive financial liabilities. And finally, we have the auditor's report. Deloitte LLP says that the financial statements present fairly, in all material respects, the the financial position of Lloyds Banking Group. They also audited the internal controls and found them to be effective. This is the stamp of approval, so to speak, that their financial reporting is sound. They also identified a few critical audit matters, which are areas that required significant auditor judgment. These included expected credit losses, regulatory and legal provisions, defined benefit obligations, and the valuation of complex financial instruments. These are all areas with inherent subjectivity and estimation. So, what is the big picture here for Lloyds Banking Group? Financially, they appear to be in a strong position. Their net interest income is growing, their loan portfolio looks healthy with low default rates, and they've managed to increase their dividends and initiate share buyback. The regulatory environment is complex, as it is for all major banks, and they are navigating that diligently. Risks are present as discussed in their extensive risk factors, from economic uncertainties to operational challenges like cybersecurity. The motor finance provision is a clear example of a significant legal and regulatory risk that has materialized. However, the bank's management seems proactive in addressing these, evidenced by their strong capital ratios and the auditor's positive opinion on their internal controls. Overall, Lloyds Banking Group appears to be managing its business prudently, balancing growth with robust risk management. While future economic and regulatory challenges are always a concern, the report suggests a company that is resilient and focused on shareholder returns. What are your thoughts on these numbers and Lloyd's strategy for the future? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate analysis. And as always, join our Discord community for more discussions. Thanks for watching, and I'll see you in the next one.